Hello, and welcome to today's presentation. Buy, sell, or develop, Prism workflows can help screen upstream deals. We'd like to go over a few housekeeping notes before we begin. All attendees are entered in listen-only mode. If you have a question during the presentation, please use the Q&A tool. We will have time at the end of this presentation to answer all submitted questions. And now I'd like to introduce our presenter, Ryan Luther, Vice President of Capital Markets. And I will turn it over to you, Ryan.
Great, thank you. So today I'm going to be presenting on a kind of a workflow using Prism and kind of showing exactly how we can answer some questions that we often get from our corporate clients. And so this is a dashboard I have set up already, and you can see I've got some text laid out here, just kind of walking through the thought process that we have when we're asked this question. The question I'm talking about is, do we buy, sell, or develop? And really, it's the kind of question we get asked from an operator that is already in an area and may not be having the best results, and might be wondering, is it my acreage that's inferior? Should I buy a better position in the same basin? Should I sell it altogether, or should I develop it out? And really, maybe is there things that I can change that could improve the developed value of this asset? And so I'm going to kind of walk through these three questions and show how you can use the Prism platform to kind of do a deep dive and answer these. So first, and I guess within this question, I guess the topic I'm going to use for today's discussion is Marathon, and specifically their Delaware asset. So should Marathon, buy a better Delaware asset? It kind of comes down to these two questions as well, like, is this asset competitive with its portfolio? And is it more of a geologic issue or an operational issue? So to answer the first part of that, is it competitive with their portfolio? I'll show you my filter set here. I've filtered down to horizontal wells, last couple of years of well results, and all wells operated by Marathon. The first two plots here kind of show the break-even and NPV associated for each of their wells. Each dot here would be one well from those vintages I filtered to. And I've grouped them here by basin that they operate in. So what we can gain from this, we can see that in the Bakken and Eagle Ford, they're pretty competitive basins, very low break-evens, around mid $30 range. However, the Delaware and the Scoop Stack basins are quite a bit higher, closer to $50. We know that the Mid-Con region is typically a higher break-even area for all operators, so that's not too surprising. But the Delaware is one of the most economic plays. It certainly could compete with these lower break-even areas in the Bakken and Eagle Ford. At least other operators seem to compete at that level. However, Marathon's results have not really kept up with the average. So yes, it is a competitive area, but Marathon's results in this area have not been competitive with their other areas of focus. And so it would make perfect sense for them to allocate capital away from the Delaware and towards the Bakken and Eagle Ford, where they still have quite a bit of inventory and can just generate better corporate returns, especially in today's environment. And that's actually something that we've seen this year. They've been shifting capital away from the Delaware, which makes sense given the results we've seen. So I'll kind of zoom in on the map here to their Delaware position, and we can dig in a little deeper on the performance of this asset. And so, and try and answer, this question, is it geologic or operational? Because like I said, most operators in this region are getting better break-evens than, $50. So it does speak to there either being a problem with the position or, the completion and spacing design that the operator's been using. So to benchmark Marathon's Delaware operations, this is quite a common workflow we do a lot of the time. What I'll do is I've already filtered their operated wells from the last couple of years. We have an advanced polygon tool we can use to put a radius and draw kind of a catchment area around all of their operated wells. I'll just do a 3-mile radius. And you can see it's now created these polygons. When I go back to my filter set, I can turn off Marathon as the operator, and it'll now throw all of the operators that have wells within that catchment area. You can see Marathon kind of has their acreage is spread across the New Mexico portion of the Delaware Basin. They have two areas where they've been active the last couple of years. And for the large part of the majority of their wells have been in Eddy County here. And because these are kind of two different regions, I'll just focus on this asset for today's purpose. But definitely, if we have more time, I'd be going through kind of each asset on its own. So we're now looking at all the operators with wells the last couple of years. I have a second tab set up here called benchmarking, where I've just added a few different plots and grouped them all by tickers so that we can easily compare well results and try and triangulate on what's driving the well performance. So if I just search for Marathon, it'll just highlight where they plot on each of these. The first one here is looking at the break-even WTI price. So again, we can see Marathon's at the higher end of this range, and we compare that against operators with directly offsetting their operations. We can see almost everybody's doing better other than some of these other private operators. So we could try and figure out, what's driving that. Is it the well performance or is it the well costs? Is there something to do with completion design that's resulting in poor well costs or poor well performance? So looking at this, the second plot here is the oil EUR per 1,000 feet of lateral length. We can see Marathon's again at the lower end of this. And so that's definitely indicating that well performance is at least part of the issue. Being this low, I would suggest that either they're spacing wells too tight or maybe not doing intensive enough of a completion design. So that's an issue where they could probably change some things to improve and be closer to some of their peers like Matador or Mewbourne, who two operators are pretty active nearby in this area. So we could try and figure out, what that is, what that's kind of driving this underperformance on the EUR side. Looking at the MPVs per well, another kind of economic output variable that we can use to assess their performance. We can see they're actually the absolute lowest, which tells us, combined with the break even and its low EUR per foot, it's probably because they're doing shorter lateral lengths. They're not getting those larger MPVs per well. And so looking at that variable, we can look at lower lateral length, and yes, they are doing a lot of wells around 4,000 feet. At least they have been the last couple of years. And most operators in this area in New Mexico, the land positions are a bit more scattered, and a lot of them are already leased for only 1 mile laterals. So we do see a lot of that. However, a lot of their peers have been moving towards longer laterals, doing more of a mix of 1.5 mile or 2 mile laterals. Even Matador historically had done very short, and they've moved to 2 miles this year, which has improved their performance quite substantially. So that's one thing they could do that would certainly improve things like their well costs. You can see this plot here, well cost per foot. Marathon's definitely at the higher end. And so along with Matador, those short lateral operators. So definitely doing longer laterals, I think would help with that. And when it comes to this question, should they buy something else in the basin? I think this alone kind of tells us that, you could probably bolt on some acres that would allow this operator to extend its lateral lengths. That would improve its cost per foot and generally improve its single well economics. So that's definitely one option that we think would be a good option for Marathon. Beyond that, we also saw that the oil EUR per foot of lateral length was at the very low end. So moving from 1 mile to 2 mile laterals, we would expect to see improvement in absolute EURs, but some degradation in the per foot EURs. So they're already at the low end, and that might even push them lower. So there's something more than just doing long laterals that they probably need to do. So we can look at the completions and the spacing to try and get a sense of if they're doing things similar to their peers or most optimally. Looking at the profit in terms of pounds of sand per foot, we can see that Marathon is actually kind of at the mid to high end of its peer group. So it's probably not understimulating in terms of the sand. If we look at the fluid intensity on this plot, you can see they're actually at the lower end. So that could be a bit more of an issue where they are understimulating their wells in terms of the fluid intensity. And the completion intensities really kind of go hand in hand with spacing. If you're doing a tighter spacing, you might not need as high intensity. So we can look at that as well. This top plot is looking at the horizontal distance between wells, the horizontal spacing. We can see Marathon is kind of in the middle. Definitely not. It doesn't look like it's going too tight, at least not on most of their wells. You can see some are a little bit tighter at 660 foot spacing. but the majority are around 1,000 feet or over. So it doesn't seem like the horizontal spacing is too tight. If we look at this plot here, this is looking at the vertical spacing between landing zones, assuming a landing zone is 100 feet vertically up and down. So looking at Marathon here, we can see that almost all of their wells are at a very dense vertical spacing. I've colored these by intervals so you can see exactly what benches they're drilling. And it looks like a lot of the white and pink, which is the Wolfcamp XY and the Wolfcamp A upper. Those zones are a little bit thin in this area, and so if you're going to drill both of those, they are going to be pretty close to each other, which I believe is why a lot of operators either skip the XY or skip the A and upper and just develop the A lower and one of those two. You can see Marathon's done that. Mewborn has a few, and Matador also has a few in those same zones, the XY and the A. So I'd expect that this is likely contributing to some of Marathon's well performance issues as well. And this is another thing that they could probably do is skip one zone, which would allow them more vertical space between their benches, and probably would result in a higher well performance on a per foot basis. And this finally is just the isopac looking at, which kind of goes hand in hand with that vertical distance between landing benches. You can see a lot of those wells are pretty thin for them. Whereas in other areas, you can see Oxy, some of their Wolfcamp X or Wolfcamp A wells are a bit further, are a bit wider in isopac. So regionally, we've kind of gone into a small area, but there can still be some differences there, which could account for some operators needing a different spacing design to optimize their position. But yeah, so I think like this benchmarking analysis is something we do all the time, which really just it helps us, kind of dial in, what's really going on with the well performance. And in terms of this first question, I think, or the second part of it, I think we have come to the conclusion that it's not a geologic issue because many operators in this area are seeing pretty good performance. However, it does seem to be that there is some operational issues. One, too short of lateral lengths, and then two, the vertical density is quite tight. So there's two kind of operational things they could probably improve. And in terms of buying a better Delaware asset, they don't necessarily need to move areas in the basin, but they could probably do some transactions that would bolt on acreage to their existing position and help improve things quite a bit. So that's the first part of this question. The second is, should we sell the asset or should we just continue developing it as is? So to answer that, we really need to get an estimate of what is the potential M&A value for this asset, and two, what is the developed value if they were just continue as is. So to do that, we can use Prism to really help get a sense of M&A transaction multiples, as well we can value the PDP of this asset base. And so I'll show you how you can do that. Typically, what I'll do is I will filter I'll filter down to Marathon as a ticker right here. And then I want all producing wells. And then what I'll do is I'll turn off these other filters I have, like this polygon, and I'll turn off this vintage and horizontal wells. This will give me every well of theirs in the Delaware Basin asset that's currently producing. And from there, we can pull out a base decline to build our estimate of the current production value or the PDP. So this production data tab is kind of how we do that. We can use this to build type curves for our go-forward development model, as well as our base decline model. And so I've filtered all of their producing wells. I'm just going to group this by regions so that I get one curve. However, if I want to model these assets differently, I could certainly group this by other things like operating area or RS interval to get an understanding of how that changes for those different assets. This plot here is essentially what we're after. What we've done in Prism, we have a model that draws a well or draws a type curve on every single well, and this plot here rolls them up. So the white line is actually the actual production data, whereas the pink is the buildup with a unique type curve for every well being put on when that well came online. So you can see that it is a pretty close match, very few differences. And then this forecast is our type curve forecast or base decline forecast. So we can pull this out into Excel, just using this base decline export here. That'll go to our downloads, and we can pull that out. I've got a copy already downloaded. I'll share with you here. So yeah, this is all of those producing wells within Prism. In our backend, we've estimated all of the inputs you need for a single well economic model. So things like variable costs, transport costs, severance tax, royalty, pricing assumptions in terms of differentials, processing assumptions, yield, NGL yield, and gas shrink. We've estimated that for every single well, and when we pull this model, it'll average all of the wells in our sample set. So we kind of have a ready-to-go base decline model with all of our input assumptions, and from there we can estimate the value of the PDP. So this is running a $55 WTI deck, $3 Henry Hub, and in terms of NPV for this asset, we're paying about $600 million. So we can kind of put together an M&A estimate by combining this $600 million as the CPV. All we need to add to that is how many net acres they have, and what do we think that they could sell the remaining acreage for? What acreage multiple could they get for it? And we can use Prism to fill out these two numbers. So first of all, we have all of the shape files for operators digitized in Prism, and along with that, we've also calculated how many net acres they have in each of their disclosed regions. And so I'll scroll down to the bottom here. I have this summary table where I've filtered our land table to just Marathon and just their Delaware region. And then I'm summing all their net acreage in that Delaware region. It's about 72,000 net acres. So I can throw that in here, 72,000. And then I need to estimate the dollar per acre. And so again, you can use Prism for this. We have a pretty extensive M&A database. And so I can show you here if I turn on our M&A transactions, I can color these by dollar per acre, dollar per surface acre. That's what we'll be multiplying it by. And you can see here I'll turn the legend on here. You can see the dollar per acre values of the transactions that have occurred in the past. They're kind of all over the place, and I haven't filtered this to a specific time period. Obviously, if you're trying to look for transaction comps, you want to filter to the last year or so. However, in this market, there really hasn't been very much M&A, and I think the historical M&A comps really aren't that representative of our expectations for M&A going forward. Here at Enverus, we've done a lot of asset valuations. There's about 40 companies that we update quarterly with our NAV valuations, and I can say from doing that research, our average Permian implied kind of acreage value is about $20,000 an acre, especially in the Delaware at the moment. And so we can throw that in as kind of a public equity comp in terms of what this acreage might sell for. And so just multiplying those two, we can get how much upside would be associated with an M&A deal, and summing that with the PDP value, we can get that they could probably sell this asset for about $2 billion. So that kind of answers the first part of this question. What is the potential M&A value? But should they sell it, you really need to know what is it worth if they just continue developing it. And so to do that, I'll just refresh this quickly to clean it up. But to do that, we can pull down a development model. We can estimate go forward type curves for this Delaware asset, and we can actually drill them out using the rig model and see what is the developed value worth. So again, I'm just filtered to the last vintage of horizontal wells from Marathon in this area. If I was doing this for one of our NAV valuations, I'd probably want to break this up by their operating regions where I think type curves change. And we kind of always want to model inventory by intervals just to make things easier. But for today, given the amount of time that we have left, I'll just kind of do it simply with one curve. So again, in this production data tab, I can pull down 3 different models: a single well economic model, the base decline model we just went through, and a development model, which is essentially this single well model with inventory section and a rig model. And so you can download that and pull it down, and I'll show you. It looks, this is basically what you get when you download it. How we group it by, you'll get a column for each of those. And so I've just grouped it into the one region. So this is using all of Marathon's operated wells. So this should give us kind of the performance in terms of the single economics. You can see those break evens are around $50. Then NPVs are around $1.5 million. And so that's representative of the way Marathon's been developing this acreage. We can see what it's worth is in terms of the totally developed value, not just single model, by filling out this inventory section. This kind of comes from Prism, not filled out, and it's up to the user to enter some of these. So I've gone ahead and started it basically throwing in the 72,000 net acres that we looked at before. This viability assumption is extremely important, and this we can really use Prism to help narrow in on. So there's kind of two ways that you can go about trying to get an estimate of that viability. One, you can simply just color the laterals or the wells in the map by any of the economic outputs. So you could do something like oil EUR. That would give you a sense of, where do I need to start cutting off this acreage because the well results are deteriorating. Or you could even do something like break even, which will give you a look into, the well cost side of things as well as the productivity. And that should kind of help you narrow in on what regions you would want to give credit to and what areas you might not. The other way you can do this is to look at the geology. We have a pretty large geo model that we've thrown into the platform. So if I just filter this to one of the intervals, I'll show you as an example, maybe just the Wolfcamp A upper. It'll start just by plotting by depth. So this is the TVD, and we can see, these shallower parts out to the west are where some of those worst performing wells are, and so that might be where we kind of want to risk off some of the acreage or use our viability to risk off and account for that. But there's several other variables that you can turn on if you wanted to get things like ISOPAC can kind of help with our spacing assumptions in terms of how thick is each zone, how many wells per section do I think we could deplete this. We can look at clay volume, what's the quality of the rock in this area for this zone, water saturation, all of these kind of output variables like hydrocarbon pore volume, TOC. We can look at reservoir temp or mud weight as a kind of a sense or a implication of the absolute reservoir pressure. All of those variables kind of help us come to a conclusion on how much acreage we should be giving credit to for inventory. I don't have time to show that all today, but I'll just for now assume 50% of their acreage is viable. Beyond that, we'll assume, call it 5 zones: the second Bone Spring sand, the third Bone Spring sand, the Wolfcamp A upper, Wolfcamp A lower, and the Wolfcamp B upper are kind of the main zones that are getting developed in this region along the state line. So we'll go with those. The historical lateral length and historical spacing, we can pull these straight from Prism. When we pulled our PDP, we have summary tables we can build that will give us the total producing well counts as well as the horizontal spacing and lateral length of all those producing wells. So we can enter that here to estimate how much acreage has been drained by all the existing wells. And then the go forward lateral length and spacing is again something we can get when we pull this single model. The 85 wells that are represented here, we want to make sure that our spacing is kind of aligned with those, and our lateral length is aligned with the performance of those, or that these assumptions are aligned with our go forward expectation. So all of those variables can be pulled from Prism quite easily, and combining those, if I refresh this, that'll give us kind of our developed value. So I'll scroll up to the top here where we have the development value summary. I've just ran out a rig schedule that takes 20 years to equally go through all of their 1,500 net remaining locations that we got to. And in terms of the developed MPV, that ends up being about $950 million. So going back to here in terms of what they could develop this for, again, we know the CPV is $600 million. We now know that the development upside is worth about $956 million. We can add those two together and we can say that they could develop this themselves for about $1.6 billion. And so if you're comparing, should they sell or should they keep going? They should probably sell rather than keep doing what they're doing, because the well performance really isn't that strong or that accretive. But there's kind of a third question that we also get asked is, do we develop and do we change our development, or what can we change? And we kind of showed you some of the issues that we think could be plaguing some of the well results. But the simplest way for us to go about it is to just say, if they were to improve their well performance to be aligned with the offset peers, would that be better? And how big would that delta be? Can we quantify that? So again, we've already determined what the developed value is the way they're doing it. What if we changed the completion design and type curves and well costs and assumed that of their peers? And so just clean this up a bit. The way we could do that, again, if we just do that acreage polygon, assuming like a 3-mile radius around their wells, and then we turn off their ticker filter so we get all operators in this region. This will allow us to pull a type curve that represents offset drilling as well as a bit of theirs. But you can look at the wells here. It's definitely weighted more towards their peers that are offsetting their operations. And so again, I can just pull down this development model using that type curve. And in Excel, I'll show you what that looks like. So this column is the operated by Marathon type curve and well cost assumptions, and the column to the right of it is what we just pulled and filtered to all of those offset operators using their well design, their well costs. And so just looking at the single economic summary, you can see there's quite a big uplift in the MPV per well. Everybody offsetting Marathon, the break-even's closer to $37 a barrel instead of 48, and their MPV is almost above 4 times that of Marathon. So there's definitely going to be a lot of uplift from them migrating towards the pattern of offsets. But one of those things I mentioned was the vertical spacing. And so offsets are definitely not doing the same vertical spacing. And because of that, they're getting less inventory. So when we go down to our inventory section, we can model it out pretty much the same. I think the only difference we would want to do is model even the same lateral length. I think the only difference we'd want to do is one less zone. So instead of 5, we'll assume they're doing 4. And because they're doing 4 zones, we'll assume that they're kind of skipping one of those wider spaced wells or zones to get a little bit tighter spacing. But ultimately, it results in less inventory. So the offsets are definitely getting less inventory than Marathon, but much better well performance. And so if we go back up to that development summary, recalculate this, and you can see instead of getting about $1 billion of upside value, if they were to change their type curve and well costs and operating costs towards their peers, that would change to about $3.5 billion of upside value. And so going back to this summary here, we can again kind of compare what the total value is here. $600 million for the PDP and $3.5 billion for the upside development. So we're getting about $4 billion of asset value. So yes, they could sell it. That's probably better than what they're doing if they just develop it as is. But they could actually change the way that they're operating this asset, and there would be a very material uplift in developed value. So when it kind of comes to this overall arching question, should Marathon buy, sell, or develop with regards to its Delaware position? We would say it should develop, but it should learn from its peers. And what I hope I've shown you today is that in a pretty quick half-hour workflow, you can kind of come to a conclusion of what's going wrong with this asset, how can I fix it, and what's kind of the most optimal thing to do in terms of developing or selling or buying more assets in this particular region. There's a lot more to it, and I could get into a lot of detail, but we're on a limited time schedule today. So with that, I'll kind of leave it, and we can move over to Q&A. If you guys do have any, or if anybody does have any questions, you can contact this email here, businessdevelopment@enverus.com, and we'd be happy to set up a one-on-one consultation anytime to chat with you about anything you want to discuss further. Yeah, with that, I'll kind of turn it over to Q&A.
Thanks, Ryan. Just as a reminder for those that would like to ask any questions, please just use that Q&A tool on your screen. The first question that we did get here is this presentation going to be available after today? The answer is yes. We will have this available in 2 days on our NAPE page as a replay. So you'll be able to access that there. The second question here is, are your NPV values after tax, depreciation, and amortization?
Oh, yeah, that's a good question. They're not after corporate taxes. They're kind of like a half cycle or like a field level single well economic summary. So we account for severance taxes and royalties, but we don't account for corporate level taxes or depreciation.
Perfect. The next question we have here is, how has your view of remaining inventory changed relative to a few years ago?
Yeah, that's a great question. So yeah, our Permian team has been doing a lot of work in terms of trying to analyze some of the parent-child degradation. I'd say a few years ago in 2016, we didn't have all the data tools that we have available now. So we didn't have a spacing model. It was very hard to really tell even just what zone wells were being drilled in. And so those kind of enhancements that we've made in our data background of Prism have allowed us to do a lot of analysis trying to figure out, what is the degradation in terms of parent-child within the same zone as well as across zone. And what our team has found is that the cross-zone parent-child degradation is actually quite severe, and some operators have been trying to fully develop all of the zones in a given section as they develop it, whereas others have been prioritizing developing only one or two of the best zones. And those operators that only prioritize a couple zones are the ones that now have a lot of remaining inventory that would have to be drilled as kind of a child interval relative to the already developed intervals. And so we'd expect there could be some performance degradation there, or they may just not come back to that section, which means inventory. If you assume that they never come back, inventories are quite a bit lower than we would have assumed, 4 years ago, and when there was still a lot of virgin sections. At this point, most sections have at least one well on them.
Great, thank you. Once again, if you have any questions, please feel free to submit them. But as of right now, we haven't had anything come in. As a reminder, if you'd like to set up some time to kind of go into this a little bit further, please email businessdevelopment@enverus.com. But otherwise, thank you so much, Ryan, for your time, and everyone for joining today. And have a great afternoon.
Great. Thanks a lot, everyone.